We now come to the final reading in equity, which is equity valuation, concepts and basic tools. Estimated value and market value. The intrinsic value of a security is based on its fundamentals and characteristics. When estimating intrinsic value, you are implicitly questioning the market's estimate of value. So understand these points. When we say a security is overvalued, we mean that the market value is greater than intrinsic value. Undervalued means that market value is less than intrinsic value. If you have an efficient market, then securities are fairly valued. If the market value is not the same as intrinsic value, then consider the following. Is the difference marginal? So do we just have a small difference or a major difference? How much confidence do you have in your model based on which you came up with the intrinsic value? Model sensitivity to assumption. So if you change your assumption about growth rate or change your assumption about some other aspect, how much will the intrinsic value change? How many analysts are evaluating this particular stock? Will market price move towards intrinsic value? So you believe the intrinsic value is much higher, but do you think the market will also start believing what you believe? Now here is a classic question. You do an analysis. The market price, let's say, is 25, and you come up with an intrinsic value of 35, and there are 50 analysts who are tracking this share. Okay, is it possible that you are the one who made the mistake and the other 50 are actually correct? That is quite likely. So when you get a number that's very different, chances are that maybe it is your model that has an issue. So the best strategy would be to go back, look at your model and see if you've done something wrong. If you are convinced that you are right, then obviously buy the stock. We now talk about major categories of equity valuation. And just as a high level point, at level 1, we scratch the surface. We just talk about valuation at a high level. At level 2, this material is covered in immense detail. So these are the 3 kinds of models. Discounted cash flow model, where we estimate the intrinsic value as the present value of expected future benefits. Multiplier models, here we estimate intrinsic value based on a multiple of some fundamental variable, so price earnings, price to book, and so on. And asset-based models, here we estimate intrinsic value based on the estimated value of assets and liabilities. The choice of model depends on availability of information and the analyst's confidence in the appropriateness of the model. Generally, analysts will try to use more than one model. Okay, here we'll talk about present value models, and the most basic present value model, and the one we talk about here, is the dividend discount model. What we are simply saying here is that if you have a given stock and you expect a certain dividend in the upcoming few years, so this is time 0, you expect a dividend of 1 at the end of period 1, then you expect another dividend here, and you expect a third dividend, plus you expect the stock price to be 20. So how do you come up with the value at time 0? You take each dividend and you come up with its present value. The fastest way of doing this is on your calculator. So just plug into your cash flow register the numbers. Where is this 21.2 coming from? It is coming from the fact that the third dividend is 1.2 and you expect the stock price to be 20. So 20 is the stock price, the dividend that you get is 1.2. So you add the 2 up, 21.2, plug in these numbers, plug in the discount rate of 10% which is given, and compute the NPV. This is the fastest way. The long-winded way, which is often shown in the curriculum, is to take each number and then find the present value and then add up those present values. Don't do that on the exam. On the exam, use the calculator. More on discounted cash flow. In practice, the free cash flow to equity and free cash flow to firm models are used. Why? Because very often you might have a company that either doesn't pay dividends, or you might have companies where the dividend pattern does not bear a clear relationship with the earnings growth of a company. So there you use FCFE. And you might recall from FRA that this is the formula for FCFE. The overall value of the company is the present value of all future FCFEs. So I've already alluded to why FCFE models are preferable to DDM. So it is where a company either doesn't pay dividends or a company doesn't have a clear dividend policy. Use CAPM to calculate the required rate of return. And we've seen this over and over. We've seen this in corporate finance and in portfolio management. So use CAPM to come up with a discount rate. You can estimate the cash flows and then discount the cash flows using CAPM. For a non-callable, non-convertible preferred share paying a level dividend D, what does level dividend mean? It means an equal dividend. So D then is essentially a perpetuity. So what's the value of a preferred share? We simply use the perpetuity formula. So D is the payment divided by the discount rate. Other types of preferred shares to consider: shares which mature on a given date. So there you look at all the cash flow till that date. Callable shares. Let's say that you have two shares A and B. So A is non-convertible, non-callable, and this has a value of 100. B is callable. Should this have a value more than 100 or less than 100? It should have a value less than 100. I'm just picking numbers here. Why? Because you as an investor don't like the fact that it's callable, so you'll pay less for it. Shares with retraction option, which is basically puttable shares. Here you would pay more because here you have the option to give the share back to the company. Perhaps one of the most important models in equity analysis is the Gordon growth model. So what this says is the following. If this is time 0 and at time 1 you have a certain dividend D1 and you expect this dividend to grow at a constant sustainable rate of G, then the value at time 0 is equal to D1 over R minus G. Sometimes D1 is not given, D0 is given. Then you calculate D1 by saying that D1 is equal to D0 into 1 plus G. The way you estimate the growth rate is by taking the retention rate times the return on equity. So return on equity is net income over equity. Retention rate is the percentage of the net income that is retained. So if a company has net income of 10 and on average it retains $3 out of 10, then what's the retention rate? It is 0.3. Sometimes what you might be given is the following. You might be given for 3 years, you might be given the dividend. So you might be told dividend is 10, 15, 20. And then you will be told that from here onwards, the growth rate is 5%. So how will you value this company? You will discount the 10. You will discount the 15, and then what you can do is, since this 20 is growing at 5%, you apply the Gordon growth model. So at time 2, which is one period before, this will have a present value of 20 over R minus G. So this 20 over R minus G covers the 20 and all future dividends which are growing at 5%. So you have this number discounted back, 15 discounted back, 10 discounted back, and add those 3. That will give you the value. Next we come to multiplier models. The price multiple is a ratio that compares a company's share price with some monetary flow / value for evaluation purposes. These are the classic multipliers. The price to earnings ratio. The trailing PE refers to the price at a given point in time divided by E0, which would mean that if you are at this point in time, you have this price over here divided by earnings over the last year. Forward or leading or estimated PE would be P0, price over here, divided by estimated earnings in the upcoming period. Price to book is price divided by the book value. Price to sales is price over sales. Price to cash flow is price over cash flow. For a growing company, what will be higher, the leading PE or the trailing PE? Note that for a growing company, the trailing PE will always be higher. Why? Because P is the same. For a growing company, the old E is going to be lower, so the ratio is going to be higher. Now, you need to understand the relationship between price multiples, present value, and fundamentals. We've already talked about this relationship. This is based on the Gordon growth model. If you divide both sides of this equation by E1, then what do you have? Then you have P0 over E1, this is the leading PE, is D1 over E1, which is the payout ratio, divided by R minus G. So if you look at this question, this is an interesting question where you are given numbers based on which you first need to find the growth rate. So you are told that in 2008 the dividend was 1. Then in 2012 the dividend was 1.8. So in 4 years we went from 1 to 1.8. So you compute the growth rate, which is 16%. Then you do the PE ratio is the payout ratio, which is given 0.4 divided by R minus G, and you come out with a PE of 10. So make sure you can do this calculation. Justified forward PE estimates can be sensitive to small changes in assumptions. So if we change our assumptions slightly about, say, the growth rate, that will have a big impact on the ratio. The method of comparables. This method compares relative values using multiples and is based on the law of one price. So I'll illustrate a point here that's very important. So let's look at a certain ratio, price to sales ratio. Now, all else equal, you want to buy a stock with a low ratio. Why? Because that's just saying that the price is low per unit of sales. If we were looking at PE, then all else equal, you would want a low ratio, because that is saying that per unit of earnings, the price is low. As long as you are comparing similar things, right? So if you are comparing similar companies, then in this particular scenario, General Motors is looking like the best value, because you are just paying 1 cent per dollar of sales. But then obviously an analyst should go and figure out why this is so cheap, and you then figure out whether you still want to buy this or not. But simplistically, between Honda and Toyota, let's say you figure out that they have the same expected growth rates and are more or less similar. Which one would you rather buy? You would rather buy Honda, because you are paying only 0.49 per dollar of sales. If you look at Canon stock, is it overvalued or undervalued relative to historical levels? So this is where you are looking. So PE is 11.3. This is lower than what it has been in the past. So all else equal, you would want to buy over here because it is undervalued. But as a diligent investor, you need to understand why this is happening. And if you actually go into details, you might realize that Canon is being threatened by the cell phone industry, in the sense that if every cell phone has a camera, then is that good for Canon or not? It's not. So that might actually explain why this multiple has gone down. But all else equal, a low multiple is good. What is the primary difference between PE multiples based on comparables and PE based on fundamentals? The difference is straightforward. With PE based on comparables, you look at the PE of a particular company. So you look, let's say that I also come up with PE ratios over here. Let's say Honda's PE is 10 and Toyota's PE is 12. So I'm deciding whether Honda is good or bad by comparing the PE with another company. If Honda's PE is lower, then I say Honda is relatively undervalued. In the method based on fundamentals, which we saw on the previous slide, the PE is based on the fundamentals of the company. So it's based on the dividend of the company, the required return, the growth rate, and so on. So how do you decide whether or not to buy a stock based on the fundamentals? If you come up based on fundamentals with a PE of 12, you plug in the number. Actually, let's use this. So let's say you come up with a PE of 10. And then you look at the actual market price, and you look at the actual, or you look at the expected earnings, and this turns out to be 11. Would you buy the stock or not? This stock is overvalued. You will not buy it because given the market price, the multiple is 11. So according to the market price, this number 11 is higher than the multiple that you think is justified based on the fundamentals. So you would avoid the stock, you would not buy it. On the other hand, if this PE had been 9, the market PE would be 9, then this would mean the stock is undervalued and you would buy it. Next we come to enterprise value, and you need to know this formula. The enterprise value is a measure of the overall value of an entity. It's equal to the market value of equity plus the market value of debt plus the market value of preferred shares minus cash and cash equivalents. If market values are not available, then you should use estimates. Enterprise value to EBITDA is a commonly used multiple. So you come up with the enterprise value from here. You come up with EBITDA based on the financials, and this is essentially commonly used. EBITDA is a proxy for cash flow. It's earnings before interest, tax, depreciation, amortization. Now here again I'll ask you a basic question. Let's say that you have company A that you are evaluating and B is the comparable company. Let's say that the enterprise value to EBITDA ratio for B is 10 and for A it is 9, and you believe that A and B are very similar. So is A relatively undervalued or overvalued relative to B? So A is undervalued because the enterprise value per EBITDA is lower for A. So we say that between A and B, A is undervalued. So if you had to buy one of these two, all else equal, you would buy A. There are also other ratios, so you can have enterprise value and you can have divided by CFO, or you could have divided by some other, you could have this divided by free cash flow to firm, but at our level, the major one to worry about is enterprise value to EBITDA. And finally, we talk about asset-based valuation. This valuation method uses estimates of the market value or fair value of an entity's assets and liabilities, and is generally suitable for companies that have a low proportion of intangible or off the books assets. This is commonly used for valuing private enterprises. Other factors to consider include the following. Book values might be very different from market values. Some tangible assets are not reported. Some intangible assets are not reported, and asset-based value could be considered a flow value. In other words, you just look at the tangible assets, that's a flow because intangibles will have some value above that. Asset values are hard to estimate in a hyperinflationary environment. The next few slides talk about the pros and cons of the different methods. So when you do comparables, then here are the advantages. You predict future returns, it's widely used, easily available. Time series comparison or cross-sectional comparisons can be done. These are the disadvantages. You can read this, but I'll highlight the main ones. Not always comparable across firms. So I've been making it easy. I've been saying you have A and B and you compare them, but no two firms are 100% comparable. The ratios are impacted by economic conditions. So if you are looking at PE, then obviously the economic condition will impact earnings, which will impact the ratios. This might conflict with the fundamental method. It is sensitive to accounting methods because different companies will use different accounting methods, so they'll have different EPS. That might impact the ratios. For certain ratios such as PE, you can have a negative earnings number, and then that makes the PE ratio meaningless. All right, discounted cash flow, advantages are that it's based on the present value of future cash flows. That's a theoretically good thing to do. It's widely accepted and used. Disadvantages are that inputs have to be estimated. You need to estimate growth rates, you need to estimate future cash flows, and your estimate of value is very sensitive to the inputs that you use. Asset-based models. The advantage is that with an asset-based model, the number that you come up with can be thought of as the floor value. When assets have easily determinable market values, that's where this method works. And it works for companies that report fair values. For companies that are reporting all their assets at historical cost, and if the current fair value is very different, then this method is not easy to use. Disadvantage is where market values are hard to determine. Market values are often different from book values. This does not account for your intangible assets very easily. In hyperinflationary environments, this does not work. That brings us to the end of equity, and I just want to make a simple point here. I'll not read through all these formulas, we've done them already, but note that there are not that many formulas to learn, and all these are fairly straightforward. I'd say the only tricky ones are right here. The margin call price, return is fairly straightforward. This you know. Gordon growth model, I hope you can do in your sleep. This is simply derived based on the Gordon growth model, and you need to learn enterprise value. The real challenge with equity is learning all the facts. So my advice, as always, is just practice a lot of questions, and then through practice you will learn the facts.